You earn too much money to contribute directly to a Roth IRA. This is the reality for high-income investors seeking tax-free growth. For 2024, single filers began phasing out Roth eligibility at $146,000 MAGI. They are completely ineligible above $161,000. Married couples filing jointly start phasing out at $230,000. They become ineligible above $240,000. The maximum annual contribution limit is $7,000 for 2024. Individuals aged 50 and older can contribute an additional $1,000 catch-up amount. High earners exceeding these income thresholds need a specific workaround. The Roth IRA conversion strategy, known as the backdoor, provides this solution. It allows you to bypass the income restrictions legally. We detail the exact steps and critical tax pitfalls you must avoid. This strategy unlocks tax-free growth regardless of your income level. The first step requires a contribution to a traditional IRA. This contribution must be designated as non-deductible. This means you do not claim a tax deduction for the contribution. The ability to make this contribution is not subject to any income limitations. You must report this contribution to the Internal Revenue Service using Form 8606. This form establishes your basis in the IRA. Basis represents the principal amount that has already been taxed. Establishing basis is absolutely critical for the next step. This amount will not be taxed again upon conversion to a Roth IRA. Form 8606 must be filed with your current year's tax return. This documentation proves the funds are after-tax money. The second step involves converting the non-deductible traditional IRA balance into a Roth IRA. This conversion must be executed immediately after the contribution is made. Immediate conversion minimizes the time the funds have to accrue earnings. Any earnings accrued between the contribution and conversion dates are considered pre-tax income. These minimal earnings are taxable upon conversion. The original non-deductible principal is converted entirely tax-free. The conversion is reported on Form 8606, specifically Part 2. This reporting occurs in the tax year the conversion physically happens. This is true regardless of the tax year the contribution was designated for. For example, a 2024 contribution converted in 2025 is reported on the 2025 tax return. The conversion is a non-taxable event if no earnings have accrued. This two-step process legally completes the backdoor Roth strategy. The Pro-Rata Rule is the primary tax complexity of the backdoor Roth strategy. Internal Revenue Code Section 408 D2 governs this rule. It mandates aggregation of all non-Roth IRAs owned by the taxpayer. This aggregation includes traditional, SEP, and simple IRAs. The rule prevents taxpayers from selectively converting only the non-deductible basis. It stops you from leaving substantial pre-tax funds in other IRA accounts. The Internal Revenue Service views all your non-Roth IRAs as one single account for conversion purposes. If you hold existing pre-tax IRA money, a portion of the conversion will be taxable. This applies even if the contribution you just made was non-deductible. The calculation uses the total value of all non-Roth IRAs on December 31st. This total value determines the taxable percentage of your conversion. The taxable percentage of the conversion is calculated precisely. Divide the total pre-tax IRA balance by the total aggregate IRA balance. This calculation uses the balances across all accounts on December 31st of the conversion year. Consider an example with $93,000 in pre-tax IRA funds. Assume you contribute $7,000 in non-deductible basis. The total aggregate balance is $100,000. If you convert the $7,000 basis, 93% of that conversion is taxable income. This equals $6,510 in taxable income. Only 7% or $490 is converted tax-free. This calculation demonstrates why existing pre-tax IRA balances defeat the strategy. The Pro-Rata Rule makes the conversion highly tax inefficient. The most effective method to avoid the pro-rata rule is maintaining a zero balance. This zero balance must apply to all pre-tax traditional, SEP, and simple IRAs. Taxpayers with existing pre-tax IRA funds have a solution. They can eliminate the pro-rata issue by rolling the pre-tax money into an employer-sponsored retirement plan. This includes a 401k or a 403b plan. This maneuver is known as a reverse rollover. It is only permissible if the employer plan document allows incoming rollovers from IRAs. Once the pre-tax funds are held within the qualified employer plan, they are excluded from the IRA aggregation calculation. This results in a clean traditional IRA for the backdoor conversion. This step is mandatory if you have existing pre-tax IRA money. The Mega Backdoor Roth is a separate strategy for high earners using employer plans. This strategy requires the employer's 401k plan to permit two specific features. First, it must allow after-tax contributions. Second, it must allow in-service distributions or rollovers. The annual limit for total contributions is set by Internal Revenue Code Section 415C. This limit is $69,000 for 2024. This total includes employee contributions, employer match, and after-tax contributions. After maximizing pre-tax and matching contributions, the remaining capacity can be filled with after-tax contributions. These after-tax funds are then rolled over directly into a Roth IRA or Roth 401k. This provides a significantly higher annual Roth contribution capacity. This capacity far exceeds the standard $7,000 limit. Check your plan documents immediately to see if this option is available to you. The Backdoor Roth IRA strategy relies on the legal separation of contribution and conversion rules. This separation exists within the Internal Revenue Code. The Internal Revenue Service has consistently acknowledged the legality of the two-step process. All reporting requirements must be met for compliance. Legislative attempts to close this loophole have failed to pass into law. A notable attempt was included in the proposed Build Back Better Act. The current legal framework permits the strategy without penalty. Congress retains the authority to modify the tax code at any time. Future modifications could potentially eliminate the ability to convert after-tax IRA contributions. The strategy is currently permitted because the law allows non-deductible contributions and subsequent conversions. Utilize this strategy while the current tax law remains in effect. IRA contributions for a specific tax year can be made up until the tax filing deadline. This deadline is typically April 15th of the following year. For example, 2024 contributions can be made until April 15th, 2025. The conversion step is reported in the calendar year it physically occurs. A contribution made in March 2025 is for the 2024 tax year. If the conversion happens in March 2025, it is reported on the 2025 tax return. The contribution is attributed to 2024 when filing Form 8606, Part 1. The conversion, including any minimal taxable earnings, is reported on the 2025 return, Part 2. Taxpayers must ensure the contribution is properly designated for the intended tax year. This dual timing requires careful attention to Form 8606 filing. The primary benefit of the Roth IRA is that all qualified distributions are entirely tax-free. This applies to both principal and earnings after age 59.5. A 5-year waiting period after the first contribution must also be satisfied. Roth IRAs are not subject to required minimum distributions during the original owner's lifetime. This allows for maximum tax-free compounding over decades. For estate planning, Roth assets provide significant advantages to heirs. Under the Secure Act, non-spouse beneficiaries must generally distribute the inherited balance within 10 years. Crucially, these distributions remain completely tax-free. The 5-year rule for conversions applies separately to the converted principal. This differs significantly from inherited pre-tax retirement accounts, which are fully taxable upon distribution.